Hello everyone, welcome to a new video. Today, as you saw in the title, I will be explaining what REITs are, and afterwards we will be looking at the company Realty Income Corporation, which is a REIT. As always within the stock analysis, we will first be looking at the company and the business model of Realty Income. Afterwards, we will check the stock price and the trend that the stock is following. Afterwards, we will have a look at their financials. And finally, I will be giving my opinion on the stock and my future plans with it. Nevertheless, remember that I'm no financial advisor and that I'm just sharing here my thoughts and my personal plans with the stock, and that you should do your own research whenever investing in the stock market. Nevertheless, with that out of the way, let's get started with the video. According to NAREIT, which is the National Association of Real Estate Investment Trust, a REIT or Real Estate Investment Trust is a company that owns or finances income-producing real estate across a range of property sectors. Usually these companies own and operate real estate assets that can be of different types and targeted towards different sectors. There are some that might own residential properties and rent it to like regular people, maybe like you and me. Others maybe own shopping malls. Others they own industrial buildings, logistics centers, data centers, healthcare facilities, among others. Nevertheless, becoming a REIT involves meeting a series of requirements that you have now in the screen. Out of all of them, I would like to specifically highlight two. Firstly, it needs to be a company that invests in real estate assets, and secondly, and very relevant for investors, it has to pay 90% of the taxable income in the form of shareholder dividends each year. This usually leads to REITs paying relatively high dividend yields compared with other sectors, but that's because basically they are obliged to it. The only thing to keep in mind as an investor is that these dividends that you collect are not taxed as normal dividends, but they are actually taxed as regular income that you make. For companies, in exchange of becoming a REIT and meeting the requirements, specifically the 90% distribution rule, they generally do not have to pay taxes. And this is because the taxes are already paid by the shareholders, since it is, as we just mentioned, taxed as regular income. So this would be the basics of REITs and what they are, and essentially, to give a very brief summary of it, it's just like a regular company, but that has to distribute at least 90% of their income among shareholders in exchange of getting very good tax benefits. And from an investor point of view, they are, in my opinion, great because it allows for small investors who do not have the capital to invest themselves and buy a full property, because it requires a lot of capital, to invest in real estate and also be very diversified, because these companies hold many different buildings across different maybe countries and different sectors, which diversifies a lot more your investment. Okay, so now that we know what REITs are, I would like to analyze one of my favorite REITs, as I already mentioned, which is Realty Income Corporation. Realty Income is an American company that purchases mostly commercial real estate and then leases it to tenants under long-term lease agreements of 10 to 20 years. In total, they own 6,500 different properties with 600 different tenants, and they are distributed across 50 different industries, mostly in the US, but they also have some in Puerto Rico and in the UK. As we can see in the map, they are also present in most of the US states, which is where most of its revenue comes from, since less than 1% of their revenue is coming from Puerto Rico and only 3.1% from the UK. Therefore, we can conclude that they are highly focused on the US market. In terms of industries, they are present in many different ones, but the 7 more representative are convenience stores, drugstores, dollar stores, groceries, health and fitness, theaters, and quick service restaurants. The majority property type, as we already discussed, is retail, followed by industrial, office spaces, and agriculture. Finally, to get a better picture of their portfolio, we can see the percentage of total revenue of Realty Income that comes from each of the tenants. And we actually can see that 52.8% of the revenue is coming from only 20 different companies. Just to name a few, we have in the first place Walgreens, followed by 7-Eleven, and then we have FedEx or Walmart, among others. What this essentially means is that for the business of Realty Income to go well, the companies that occupy their spaces need to also do well. So if Walgreens or these different companies do well, then they will pay their rent and everyone will be happy. And actually this rent collection topic is something super relevant in the current crisis and something that we will be discussing right now. As we discussed earlier on, they also have as tenants theaters or fitness studios that are currently going through very tough times, and these are the ones bringing the most problems, as we will see just in a little while, to Realty Income. But this also proves how important it is to be diversified across different industries, different segments, in order to be less reliant just on one. Nevertheless, let's stop the talking and let's actually go and see which was the rent collection for these past months. Based on the press release of September 2nd, 2020, the collection of rents is improving. We see that since June 30th until end of August, the total rent collection has increased from 87.8% to 93.5%, which is obviously much better and kind of shows that the whole situation is hopefully getting better. Now looking into the sectors, we see that the ones that are not paying are mostly theaters, health and fitness, restaurants and childcare, since 90% of the uncollected rent during the Q2 was coming from these sectors. Now we have an overview of their business, their exposure, diversification and some general figures, so I think that it is time to go and have a look at the stock itself. But before doing that, I would very much appreciate if you could hit that like button and make it turn blue. Thank you. Okay, Realty Income is trading under the ticker symbol O in the New York Stock Exchange. And at the moment of recording the video, each stock is worth $64.37 US, and at this price, its dividend yield is of 4.35% with a payout ratio according to market beat of 84%. An important point with this stock is that the dividend is paid monthly versus many other companies that paid quarterly. And this, from an investor point of view, essentially, it doesn't really matter because you get the same yield, but the good point is that it allows you to compound your money over time sooner. Moreover, it has been paying and increasing dividends for 51 years in a row, which makes it a dividend aristocrat. Finally, checking its stock graph, we see a consistent uptrend since its inception on 1994. In fact, its compounded average annual total shareholder return stands at 15.3%, which is far more than the average of other REITs or the S&P 500 index. We see that the stock has been performing well, but let's go now into the financials to get an even better picture. Looking at the Q2 earnings report and more concretely at its balance sheet, we see that they have a low debt ratio of only 45.69%. This is very favorable from my point of view, since it is a solid and conservative company with a very nice balance sheet, capable of withstanding a period of recession like the one that we are living. Not only that, but with respect to the end of last year, they have reduced the liabilities while increasing their assets, improving even more their balance sheet. Now looking at the income statement, we also see it very positive, with an increase in revenues versus last year that has also led to higher net profits reported for the quarter. Checking the historical data, according to Yahoo Finance, they have reported net profits every single year, and they have also been increasing during the past years, which is also very positive. After checking all of these, it is time for me to give my opinion on the stock itself. And personally, as I already mentioned at the beginning, it is a company that I really like. It has a very good management team and it has been performing extremely well during the past years. Moreover, their financial statements are looking great, as we have just discussed. The only thing that I don't really like about the company is that they still have theaters to rent, which in my opinion is a sector with very low potential when it comes to the future. And in my opinion, they should probably get rid of them, but they only have a small portion of that, which is relatively okay. In any case, and as I already said, I really like the company and how well run it is. And I personally, of course, own some shares of it at a cost basis of $45.20. And even at the current price, I still think that their shares are attractive. Especially considering that the company before the crash was trading at around $80 per share, and their financial statements, as we have just seen, have even improved from that point. So they are even doing better than before, but they are trading at a lower price. In any case, this is the end of the video. Thank you very much for watching it all the way to the end. If you enjoyed it, then please make sure to give it a like, subscribe to the channel if you're not yet subscribed, and as always, see you next time.